All right, welcome to the first month of the spring enrollment. And the first month is the analyst month. It is the analyst phase. And in the analyst phase, we are focusing on how can we know where price is actually heading towards. And when we become great analysts, eventually we can become great traders. This is the absolute first step that we need to take. Now, with that first step, the absolute first thing we need to understand is the first things first right here we are going to go over. So what does that mean? The first things first. Well, the first things first, meaning that we will need to understand the basis first. And the basis is the foundational levels. The foundational levels right here that you are seeing starts with number one, the bias right there. Eventually that leads to number two, the narrative right there. Then we move on to number three, the boundary, which is part of context. We move on to number four, which is also part of context. So number 3 and 4 can as well be summed up as one, but I like to dissect them and like to separate them right there to make them more clear as well. Then we have number 5, and that is the entry right there. Then we have number 6, and that is the risk management. So all these steps right here lead to a trade ID. And when you follow the steps, it gets to either a profitable trade ID or an unprofitable trade ID. Of course, our goal is to find the more profitable trade IDs at the end of this spring enrollment. Now, when we then go over the analyst phase, what do we need to go over first? That is where we have the foundational levels for the analyst phase. And that is the bias, the narrative, the boundary, again, part of that context, and the target, part of that context as well. The lower we go into this list, the more or the closer we get to the entry phase, to the execution phase, which is the next month. The hard work is always done on the higher time frame. This is something I mentioned throughout different enrollments as well. And what I mean by that is the hard work is done on the analyst phase, as you may notice. We go over most of the foundation levels in the analyst phase as well. That is because it's probably the hardest phases out there. And if we can understand this, then we are setting ourselves up for success in the execution month, in the execution phase, which is the next month. And the reason for that is because everything we do here is fractal. So I mentioned the hard work is done on the higher time frame. That's because we start off with the higher time frame. But when we then go into the lower time frame, the same thing applies to the 1 minute time frame. So the bias concepts, the narrative concepts, the context concepts that we are going to be using, that same thing applies to your entry pattern. It's all the same thing. It's just different names, essentially. Now, the reason I have bias right there marked in red is because that's the absolute first thing we need to understand before we do anything else in trading right there. And when we want to understand bias, we need to be able to dissect words. We need to be able to understand words, so we are on the same page. I like to use the analogy of math, and with math I mean mathematical equations, etc. Usually from the outside it looks extremely difficult, but at least from my experience in math, it's a lot of formulas, and if you understand the formulas, it becomes very simple. So all we need to do is remember the formulas and apply them at the right time when we need them, essentially. And that's the same in trading, where from the outside it might look very difficult, might look very, very weird almost, because people have no idea what we're doing. But all we're doing is applying certain concepts, applying certain formulas, and after that we have intuition and experience as well taking over. So the most part of our trading plan, 80%, can be done mechanical. And what I mean by that is mechanical as in understanding things, being able to define words. That's extremely important, and that is a lost art in the trading community, because everything right now is very chaotic, very vague. So let's create order in that chaos by defining words first. So everything here that we're going to go over can be learned essentially like you're studying for a test. It's all mechanical that we're going to go over right here so far. Now, that starts off again with the bias. And the bias is understanding two things. It's the draw liquidity and the direction. The draw liquidity, like I mentioned right there, the draw liquidity leads to the direction. The drawn liquidity is a target. So what are we aiming for? Are we aiming for some kind of support level or some kind of resistance level? When we understand what we are aiming for, that leads to the direction. So I want to flip that around. I do not want to focus on the direction leads to the target. I want to focus on the target leads to the direction of price action. Now, when you have a target and that direction right there is simply said when we are talking about bullish or bearish. The drawn liquidity right here. PD rate, the closest target. So the closest target, meaning what are we essentially aiming for? What is the first PD rate, the premium or discount array that we are aiming for? If we are aiming for a premium array, so right here, the direction, are we targeting a premium or discount array? If we are aiming for a premium array, then we already understand that price is bullish because price needs to go higher in order to target premium arrays. If we are targeting a discount array, then we understand the direction because then the direction is lower prices, in other words, bearish prices. Now, to understand what PD array we are looking at or what PD array we are aiming for, we need to understand something very important. We need to understand order flow. Order flow right here says the market is always in search for a PD array. And that concept is called order flow. So drawn liquidity, and at the base of everything, there is order flow. So then, in order for us to understand the drawn liquidity, in order for us to then understand direction, in order for us to understand the bigger picture, the bias, we need to understand order flow. So I hope you can see what I'm doing right here. Every word that we are going to use right here, I want to dissect it first before we do anything else. So I can go over the foundation levels, the bias, narrative, and tell you everything I know about them. But we need to be able to understand, what do I actually mean with bias? Okay, bias is drawn liquidity direction. Well, what do you then actually mean with the drawn liquidity? And what is that PD raise? How does everything work? If we can get that out of the way and we can understand that, it becomes very simple. It actually becomes extremely simple. So that is why I mentioned it's almost like studying out of the textbook, because everything here is just objective. Now, order flow, the market is always in search for PD rate. So what exactly is then that order flow in order for us to be able to understand the bigger picture? Order flow is the following. With the first thing in order flow, we need to understand the PD rate. Order flow is unloading of previous orders and placing new orders. And this phenomenon happens at PD rates. So an order block, a mitigation block, a fair value gap. What happens behind the screens is unloading of previous orders and then placing new orders as well. So what does that look like? Well, let's say that we are in an uptrend. So we have bullish prices. Then you can imagine that when price is moving higher, I want you to visualize this almost, then at previous premium arrays, what happens? We are unloading orders. At discount arrays, so at a bullish order block, for example, we are placing new orders. That placing of new orders then eventually leads to us being bullish because we are unloading orders at premium arrays and we are placing new orders at discount arrays. What this exactly looks like in the chart is also what we're going to go over later. But that then leads to a bullish trend, which then leads to order flow. So the flow of orders in the market. Do we have more bullish orders or do we have more bearish orders? If we have more bullish orders, leads to a bullish trend. If we have more bearish orders, that leads to a bearish trend overall. Now, what is then our job in the order flow understanding? We need to find out which PD array is next. So our job is to find out, well, where are we going to unload previous orders and where are we going to place the new orders? Because in between moving from those PD arrays to those next PD arrays, that is exactly where we can capitalize. So again, the movement from PD array to the next PD array, from the previous PD array to the next PD array again, it's a constant process. We are always trading towards a PD array because the market is always unloading previous orders or placing new orders. So our job is to find out, well, which PD array is next? Where is the next place where we are unloading previous orders or we are going to place new orders? And that is exactly our job. So that leads to the understanding, or a basic understanding, of order flow. We're going to dive way deeper into order flow, but this is the basic understanding right here. Then the next thing we need to understand, because order flow is seen, like we mentioned from the beginning, is seen through PD arrays. And the PD arrays are the following. These are the only PD arrays that I use in price action, and we're going to dissect them even more. The first PD array that we use is a fair value gap, also known, what you'll hear me refer to oftentimes, is an FVG. Then the second PD array that we have is a mitigation block right there. The third one is a breaker block, also known as a BB. I don't really refer to it like that, but if I'm typing or something, you might see a BB instead of a full breaker block. An order block is the fourth one right there. Then the fifth one is a swing high or a swing low. This is liquidity. This is also known as swing points. Then the sixth one, the last one right there that I use, is a previous candle high or low, a previous X high or previous X low. Now, I personally would highly advise, and I cannot stress this enough, do not add anything into this. Do not add any other PD array into this PD array list. And the reason for that is because we will simply lose accuracy. If we do not follow the steps here, then we do not follow order flow anymore. And order flow is everything. So we do not follow the draw liquidity anymore. We do not follow everything anymore. It's like the foundation is not set anymore. So the building can just fall over at any time. So if we want to build a great foundation, then we need to use these PD arrays and nothing more. That's very important, but also nothing less, right? So these exact PD arrays. Every other PD array that you might think of, for example, you might know it, a known one is an inverse fair value gap. An inverse fair value gap is, in my opinion, irrelevant, because whenever we trade into an inverse fair value gap, usually we already trade into a fair value gap or an order block. It's nothing more than what we already have in these PD arrays. So it's already incorporated into the PD arrays itself. So again, don't add any other PD array into this, please. It's for your own sake. So to understand the PD arrays a little bit better, because of course, in itself, these are already quite a lot of PD arrays. As in 6 PD arrays, that is definitely quite a lot to pay attention to overall when you're coming into the chart, especially if you need to pay attention to order flow, all these different things. So can we dissect this and essentially make it easier for ourselves? Yes, we can. That's when we look at the fair value gap in the red right there. Then we have the 3 blocks right there in black, and the liquidity, because both the swing points and the previous candle high and low are liquidity points. So we divide them now, and they are divided by the following. By the following PD arrays are dissected. The first thing we need to understand is the red one right there, and the red one was the fair value gaps. They are superior. Why are they superior? Because nothing else is valid if we don't have a fair value gap in the same leg. So let's say we have an order block, or let's say we move on from the fair value to the fair value areas right there. So an order block, a mitigation block, and a breaker block. Then we need to also have a fair value gap. So the fair value gap is everything, as in it's the superior PD array. Without a fair value gap in close proximity towards those order blocks, those mitigation blocks and breaker blocks, then those fair value areas are simply not valid. I'll show you exactly what I mean later on as well. Now, again, to sum this up, FVG, the superior PD array, nothing else is valid if we don't have an FVG in the same leg. Then once we have that FVG, we can allow ourselves to move on, because when we have a fair value gap, we can understand that there's something else there as well. There's another PD array. There's either an order block, a mitigation block, or a breaker block as well. So it's not looking, and this is oftentimes what you'll see in the trading industry as well. It's not looking, do we first have an order block, a mitigation block, or a breaker block, and then looking at a fair value gap supporting the ID? No, it's first, do we have any fair value gap that we are currently looking at on the chart? All right, if we have a fair value gap, then we will likely also have an order block, a mitigation block, or a breaker block. So those order blocks, mitigation blocks, and breaker blocks all have something in common. And that is that they are all fair value areas. They are FVA right there. And what those fair value areas look like is exactly what we are now going to look at as well. So a fair value area is a 3 swing movement, but there's different 3 swing movements. Let's first understand why it actually is called a fair value gap, why it is actually called a fair value area. When price is moving higher, in the form of this right here, we have one leg going higher right there. In this leg going higher, in this bullish price essentially, we create buy side on the market. And when we create buy side, in order for us to offer fair value, we also need to offer sell side. So when we create sell side right there, this moment, this leg higher is now offering fair value. That can be done if in the first leg higher right there, we might already have a fair value gap sitting somewhere in the form of there. Then we are offering fair value in that fair value gap. So the offering of fair value, and the reason why we use fair value gaps is because fair value gaps lead us to an overall more accurate understanding of where price can actually retrace towards. Because again, if we see this from a logical perspective, in order for us to understand and in order for us to be traders in the first place, we need to understand where price will also stop. So not only where price will go to, because that's the analyst phase, but we need to also understand where price will stop before it actually moves higher. Because when you place a trade, you have a stop loss, right? And we need a stop loss because that's the part of the risk management. So in order for us to have a stop loss, we need to be able to accurately know where price will also stop before it moves higher, where price stops and stops the retracement before it continues lower. That is where all these concepts also help you with. Now, this offering of fair value, where we now create buy side and then we have sell side right there. That can be in a fair value gap itself, can be any PD rate. That can be the more accurate, where we expect, all right, we are going to stop the retracement there to then continue higher because we are offering fair value. After we offer fair value right there, the fair value gap we can ignore. It's not relevant anymore. We have already offered fair value in that fair value gap. After we move higher and we move above the high right there, then this creates a fair value area. This fair value area that we are currently looking at is a 3 swing movement as well. So we have one leg higher, second leg lower right there, and one leg going higher right there. What this looks like in the chart is, again, what we're going to go over. Then this right now creates a mitigation block or an order block, not a breaker block, because a breaker block looks a little bit different. Then this area, this is the fair value area. So where can price now retrace towards? Well, if we are offering fair value right here and we have a fair value area right there, and price will want to offer fair value again, then offering fair value again can be done by coming back towards the fair value area to then continue higher off of that. That limits the amount that we can retrace. So we do not expect a huge retracement into the fair value area. No. We expect a retracement into the fair value area at the top right there, at the opening of the fair value area to then continue higher off of that. This is a concept that we are going to dive deeper into later on as well. I just want to show you what these fair value areas are currently. Then we have another fair value area, and that is again a breaker block. So the breaker block looks a little bit different, where a breaker block is something along the lines of this. One move higher, second move lower, and then a move higher like this. So again, a 3 swing movement, but it's in a different place. This low right here is a swing low. So we move higher, we take out a swing low to then move higher again, coming above that swing low right here, creating a fair value area right here. And this then becomes the fair value area sitting right there. Same premise, but overall it looks a little bit different. So what does this actually look like in a chart? I think that is, of course, more valuable to understand. Now, we have multiple fair value areas right here on our chart on the daily time frame on ES. I'm currently going over the daily chart. How you should define your time frames is something we're going to go into later on as well. Which market should you trade? Something we're going to go into later on as well. It works on every single market. So I'm just using ES right here as an example. Now, right here, we can see that we have one move higher. When we look at the buy side offering right there, we do not need to get super specific about which swing highs, which swing lows, what is the exact buy side delivery right there, the exact sell side delivery right there. Because once price makes a retracement like this and it moves higher, that is when we can already understand it has now offered fair value. Price is not allowed to move higher before it has offered fair value as well. So if price moves higher again, then that means we already offered fair value in that overall area. Now what we can actually see, and if we define it a little bit more, then we also see an order block right there. Why is that an order block? The order block right there is a down candle. That down candle in itself is a fair value area. Why is that? Because what happens on the lower time frame right there? Again, that 3 swing movement. We can even see that by just looking at the candles. We have a move higher, that candle right there. This candle is a down movement. So that is the sell side that is being offered. Then after we have candles moving higher. So this is the formation that is happening right there on the lower time frame at this area right there. This creates an order block, as we know it as well, again, a fair value area. Now, after that, once we come into that and we offer buy side, then we offer sell side, and we move higher again. What do we leave behind? We leave behind this fair value area, which we can also know as an order block sitting right there. So where can we expect the retracement towards? Well, if we want to offer fair value to then continue higher off of that, again, why are we offering fair value? It's because price always needs to give a fair chance for both buyers and sellers to get involved. And if we want to create or offer that fair chance, then we will offer fair value right there. We will go to the place where we need to offer fair value, and the only place we need to offer fair value is again above this high, because this at this moment in time was the only place where we did not offer fair value yet, because we only offered buy side right there at that moment in time. At this moment in time, we only offered buy side right here, no sell side just yet. The last place where we had fair value, where sell side was also offered, was this area right there. So that's the area where we can now retrace towards, which essentially, of course, also creates then this order block right here. And this order block is nested inside that fair value area. So the bigger fair value area is the top line that I have marked out right there until this low right here. Oftentimes inside that bigger fair value area, what you will find is you will find a nested PD array. And what is a nested PD array? This in itself, this order block is already one PD array. Then we have a fair value gap right here overlapping, because again, we need a fair value gap that is overlapping right there. We have a fair value gap overlapping right there with the fair value area overall. So when we then continue higher, and we also have this nested PD array, and a nested PD array is again when inside the fair value area towards the right side, we have a smaller PD array in the bigger PD array. That creates a nested PD array in the form of this order block inside the bigger order block as well. Essentially, that creates 3 discount arrays as well. That's of course absolutely perfect, because that is even stronger the more discount arrays we have as well. Now, why do we use this? And why do we not just look at order blocks, mitigation blocks, and breaker blocks as usually people would do? The reason for that is because when we understand fair value areas, it becomes very easy to dissect liquidity from fair value. Price is always doing one of 2 things. It's offering fair value or it's seeking liquidity. And when we are just looking at order blocks and we just have this order block, then if we don't understand the fair value premise behind an order block, then how far can it retrace? It can retrace into the 50%, can retrace into the 75%, can retrace into this right here before it might continue higher. We are essentially clueless. We again lost the accuracy. So I hope you can also see, and I hope this is also an eye-opener to you, why I don't use 50% of an order block, why I don't use 50% of a breaker block, or 50% of a fair value gap. Yes, there's a lot of different factors going into that as well to see if a fair value area will hold, which again, we're going to go into everything. But if we just use an order block by itself, then we might even, for all we know, we might even retrace all the way towards the bottom right there before we continue higher. That loses the overall accuracy, because if this is an area that we need to confirm on the lower time frame, and we need to use 5-minute continuation higher to confirm our entry pattern, then we are likely going to take a lot of losses before we actually get the right move. And when you take a lot of losses, everyone can take winners. Winning is not that difficult. But if you cannot avoid the loss before that winner, then you are simply unprofitable. So all profitability is avoiding the losses before you take the next winner. That's very important. Now, what is then the difference between an order block and a mitigation block? Well, actually, it's the same thing. And that's why I sum it up in, simply said, fair value areas. Because if I go down in time frames right here, and we look at this right here, this order block, then you will see that now there's also up candles in this move lower. An order block is when you have only consecutive up candles or consecutive down candles. So what we're seeing right here with the consecutive down candles, we have 2 consecutive down candles right there and 2 consecutive down candles right there before we have the up move right there. That creates an order block. So order blocks is always consecutive down candles or consecutive up candles. Consecutive up candles if we are creating a bearish order block. Now, a mitigation block is where this doesn't matter. So usually what you'll see is a mitigation block on the lower time frame is the order block on the higher time frame. Where on the lower time frame, in this case, the 4-hour lower time frame relatively seen towards the daily time frame we were just on, this becomes the mitigation block instead of the order block. So that's why I like to refer to it as a fair value area overall, because it's easier to understand, because they're basically the same thing depending on what time frame you are looking at. So right here, it is very important to understand the next thing as well, which is that why am I using the wick high right there? Small detail. I'm using the wick high because the top of that wick. So if you put your mouse on this candle right here, and at the top left right now, you are seeing OHLC. So you're seeing numbers right there. Then the H is where the highest place where price action was. It is 5066.50, which is this exact line right there, 5066.50. That exact line, the exact top of that wick where price traded, is now overlapping with a fair value gap towards the right there. Meaning it's in the exact spot where a fair value gap is. If this wick would have been a little bit lower like this, it would have not been in the exact spot. If it's in the exact spot, you mark out the wick right there. If it's not in the exact spot, you mark out the body right there, the highest body, where actually the nested mitigation block in this case, if we go into the daily, it would have been a nested order block again. Then this becomes the highest right there, the highest body, because it's not overlapping with fair value gap. But this is where it is overlapping with a fair value gap right there. So we can use this area sitting right there. That is a small detail that we need to understand as well. Again, does it matter if we only use the wick right there, or if we use the wick, or if we use the bodies? Is one a higher probability than the other? I would argue that the wick overlapping with a fair value gap is always the highest probability. So in a fair value area, if you have the wick from the fair value area overlapping with a fair value gap towards the right, it's always the highest probability. And the reason for that is because it's all about balance, right? In the market, it's offering fair value is also about balance. Meaning if we want to move higher aggressively, then we will have one bullish side that's moving higher extremely aggressively, which also comes at the expense, or comes with a side effect of creating fair value gaps higher. And if we do not move higher very aggressively, we move something like this, we might not create fair value gaps, or not a lot of fair value gaps, meaning we likely do not have a fair value gap overlapping with the fair value area with the highs that we leave behind. So that indicates if we do not have a fair value gap exactly overlapping with the highs, that it is a little bit low probability because we are less bullish. There is less intention of higher prices overall. So a fair value gap overlapping with an exact fair value high is always the perfect scenario that you're going to find. It does not mean that if it's not overlapping that it isn't valid. As long as there is any fair value gap on the same time frame towards the PDA, towards the fair value area that you are looking at. So if we did not have any fair value gap higher in this leg higher right there, then any fair value area would not be valid right there. The mitigation block would not be valid. If we did not have a daily fair value gap higher in the form of this daily value gap, then these daily order blocks would not be valid right there. That is very important to understand as well. So then we have one block left, and that one block is a breaker block. And a breaker block is, if we go into this fair value area that we're seeing right here, this is where we come into the fair value area. Then once we come into that, we see one thing, and we can now incorporate actually overall the understanding of liquidity as well. That was the last one, the last PD race that we need to go over, the swing points and the previous candle low and the previous candle high. That is liquidity. Liquidity in the form of swing lows, for example, right here, that swing low and usually good swing lows line up as well with previous candle lows. So that previous candle low right there, which is a previous daily low in this case, and again, it's fractal, so it happens on any time frame. Then on the lower time frame is a swing low. So that usually the strongest liquidity points, they line up with that as well. So understanding that is probably one of the most simplest understandings that we will go over in PD rates, where liquidity is simply, again, swing lows, swing highs, previous candle highs, previous candle lows. How can we understand if we are taking liquidity, targeting liquidity? All things we are also going to go over later on. Now, after this, after we take this liquidity right there, what do we see? Well, we see something similar to what we saw actually in the previous example of the swing movements, where we had this movement right here, the usual fair value offering right there. We also have this right here, and this creates the breaker block, where this, the low right there, is a swing low, a swing point. So when we look at this, and we have this 3 swing movement again, then this area right here, which is overlapping with fair gap, that exactly is the fair value area right there. So the difference here between this breaker block and the order block and mitigation block is that the breaker block takes out liquidity first right there, so it has a fake move essentially to then continue higher. The way you can also see it is through 2 lenses. A breaker block is a filled mitigation block, a filled order block. So it's a filled fair value area, meaning initially this right here was a fair value area right there, which we could continue lower from, but it failed to do so. It failed to continue lower off of that. So then it turns into a breaker block. A breaker block is the first reversal area as well. So the first way you can see it is it's a filled mitigation block, a filled order block, a filled fair value area essentially. And the second way you can see it is the first reversal area in price action. So after this move higher, we will only create order blocks and mitigation blocks as well right here, unless we are talking about the lower time frame. But in the same time frame where we have already one breaker block, after that we will just form mitigation blocks and order blocks as well, continuing higher until we reach some of these targets right here. So now we understand, and if we move back towards the PowerPoint, then we have gone over the superior PD rate. We have gone over the fair value areas. We have gone over liquidity right there, swing points, and previous candles. So we have a brief and a basic understanding of those PD rates and how we dissect them actually to make it a little bit easier to understand overall. Then from there, we need to move on again, because when we move on, we now need to understand the drawn liquidity. We have a basic understanding of order flow. We have a basic understanding of PD rates, which again in order to understand order flow, you need to understand PD rates. In order to understand PD rates, you also need to have a brief understanding of that leads to order flow, right? And all those things combined, so again, that the order flow and the PD rates, understanding those leads to an understanding of the draw on liquidity as well. So that's why we dissect it like that. It's very important. So the first thing we need to understand is the further, the lower probability. That's something I'm going to dive into straight after this, but that's extremely important. The number two is, so which PD array are we aiming for? And that is where the direction comes in. So essentially this lesson is all about understanding the first thing, which is PD arrays that we are using. And the PD arrays that we are using is, again, the superior, that fair value area, and we have that liquidity. Now let's say we mark out every single one of those PD arrays. Then right here, we mark out a previous candle high, we mark out a previous candle low. What is the next one that we are seeing? We have this mitigation block sitting right there. We have this fair value gap sitting right there as well. This, of course, the mitigation block is a fair value area in itself. We have a smaller order block right there as well that is nested actually inside the mitigation block. So it's a smaller PD array inside the bigger PD array. Why is this a mitigation block? Again, it doesn't have the consecutive down candles, right? There's up candles, there's down candles, that becomes a mitigation block. So these right here is the ones, these are the closest PD arrays. Now, the further away the PD array, the lower the probability. And what I mean with that is that if you want to aim for this previous candle low, is the currently that we are looking at is the furthest one, meaning that is the lower probability PD array that we are actually going to trade towards. And what I mean by that is we might trade towards that previous day low. Who knows? We might trade towards it. But at this moment in time, since it's the furthest away, it's the lowest probability. Of course, if price is already closer towards all these different PD arrays right there, then it is higher probability for price to trade towards them. At this moment in time, I marked out the fair value gap. If you wonder about that, I marked out the fair value gap right there. Of course, it's not actually a fair value gap itself just yet, only in 9 hours when that candle closes, but I just, for example's sake, I already used the fair value gap there. Now, if we want to trade towards the previous candle high right there, or trade towards the fair value gap right there in the next candle, trade towards the fair value area, that's a lot higher probability. But then even there, you can dissect it. What is the higher probability one? The fair value gap, and I would argue same probability is the previous candle high, because I would argue we're just as close towards both of them. Now, if we mark out the exact, then we see 20 and we see 38. So what is higher probability? Well, the fair value gap there, again, assuming that it is a fair value gap on the next candle, that is a higher probability right there to actually trade towards, because that is the closest, the absolute closest PD array right there. Where the further you are aiming, so if you have a premium array that is all the way up here, that's just higher, that is just lower probability overall. Lower probability meaning it's very likely and it's almost confirmed that we are, throughout this week, throughout the next candles, we are going to trade into this previous candle high right there. We are going to trade into that high. I can almost guarantee you that. But I cannot guarantee you that we are going to trade into the furthest PD array in the form of this previous candle low right there, because that's the furthest one. That's also the lowest probability one that we might trade into. So that's a simple mindset, but extremely important to understand, because oftentimes people mark out very far premium and discount arrays, where if we understand the closest PD arrays that we are aiming for in the form of the fair value gap, etc., and we see how we react off of those early PD arrays, then we will see eventually that this PD array will be the closest PD array once we have disrespected all the other PD arrays right there. So then this one becomes high probability. It's, again, constantly from discount to premium array, it's the constant unloading of orders and adding on to new orders. So when we add on new orders or we unload orders, then we're always looking at the closest PD arrays, not PD arrays that are very far off of price action. We're always looking at the closest PD arrays itself as well. When we look at the closest PD rays, we have PD rays that are on the right side of our chart, and we have PD rays that are on the left side of our chart. And what I mean by that is these PD rays, all these PD rays that I marked out right there, are on the right side of our chart. And when I refer to the right side of our chart, on the daily time frame right here, relatively seen to the daily time frame, we have this lag higher right there. From the swing low towards the swing high. Swing high in this case is not super relevant because it's not even a swing high itself yet, unless that candle closes right there. It's just a new swing low with a fair value gap higher. That in itself is an order flow lag, which we're going to dive into in later videos as well. And that order flow lag right there is where we have PD rays on the right side of our chart. Those are currently the strongest PD rays if we want to continue higher. The strongest PD rays always happen on the right side of our chart. That is where we add new orders to the market. Where we unload orders of the market is previous PD rays that happen on the left side of our chart. So for example, when we look at all the way towards the left right here, you will oftentimes also find an order block in the form of this, for example, right there. Or actually a breaker block, excuse me, a fair value area. Let's refer to it that way. And you will see that we still get somewhat of a rejection right there because we are unloading orders and we are adding new orders at any discount rate that we have in that lag higher right there. So it happens unloading, loading new orders, so adding new orders to the market, which leads to, again, if you are unloading orders at premium rates, then there's no volume, right, going lower. If you add new orders at discount rates, then we move higher because there's more pushing power going higher actually, which leads to bullish order flow right there, which leads to overall understanding of bullish prices. So to understand that right there is quite important because that is something we are going to go over later on because we need to understand where we are allowed to take entries as well, which is something I'm going to go over later on, but that is something we need to understand. Now, moving on from that, again, which PD ray are we then aiming for? That is where direction comes in. And the direction is something we are going to go over in the next few videos. Where first things first, we need to practice. And practice is what we can do is we can practice through the following things. First step I would love for you to do is mark out all the PD rays we talked about. So this can be any chart, right? You can focus on one chart. I would advise for you to focus on one chart currently. Then on ES right here, you can pick ES, the exact same time frame right here on the daily time frame. I would advise use a maximum of 2 time frames currently. So you can, ideally, you want to stick to the higher time frame, but again, it's fractal. So you can also go into the lower time frame. The way we divide time frames, how we go over that, something we're going to go over as well. So to make it easy and to sort of align yourself with the coming videos, you can go into the monthly, weekly, daily, and the 4-hour first. So stick to the daily and the 4-hour because then you actually have something to work with, of course. If you're going to go off the monthly, then the next video is not going to be in a month, right? So to have a better understanding of that, we can mark out in real time right now the daily and the 4-hour, the higher time frame PD rays right there. So if you do that, then I want you to study, and that is the next point right there, study how we deliver there. So if you mark out every single PD ray here on the daily and the 4-hour, all right, we have basically every single close PD ray right there that is relevant for the next coming days on the daily time frame. If we go into the 4-hour, let's see what else we have. We have this nested order block sitting right there as well. This time, again, the mitigation block right there stays the same. This becomes an order block right there. Then we also have the previous candle low and the previous candle high sitting right there. You can choose ES. You can also choose one of the Forex majors. You can use EU, Euro, US dollar. You can use GBP, US dollar. You can also use the dollar itself, of course. So choose one and study that one. Now, it's all the same on every single market. So whichever one you choose doesn't matter. That is extremely valuable because that overall leads to an understanding, a better direction, better understanding of the direction. And what I want you to pay attention to when you study that is candle direction and order flow direction. Candle direction is something we are going to go over on Wednesday Order flow direction is something we are going to go over on Friday. And do you need to exactly know what candle direction is already right now at this moment in time? No. Do you need to know what order flow direction is currently at this moment in time? No. You don't need to understand that. But by marking out PD rays at first, and this is actually to be honest and to tell you, this is how I came to the understanding. This is where it all started for me. Whatever I did and how I did it, when I got to my understanding, is the first thing I did. I got to the understanding of PD rays and I marked out every single PD ray that I knew of in my chart and that I wanted to use. And then eventually it becomes a studying how we deliver there, how we use those PD rays. So by first being aware of all the PD rays we have and then seeing how we react off of those, it becomes a lot easier to understand. So right here, candle direction is focusing on the next candle. So what can the next candle do? What can this candle do right here? Can it aim for the previous candle high right there or the previous candle low? It's understanding what a single candle can aim for, a single candle direction. In that single candle, you will have multiple candles. Multiple candles lead to order flow. Now that's all fractal because here on the daily, you have candle direction in the form of the current candle or the next candle, and you also have order flow direction. And order flow direction is in the form of fair value gaps. So what are the fair value gaps actually aiming for right there? What is the order flow direction here aiming for? So the multiple candles, the fair value gaps, what are they aiming for? That is what you can focus on right now. Mark out all PD rays and studying how we deliver there. Then on Wednesday in the next video for you, if you're not watching this on a Monday, whatever it may be, then it's just the next video is where we're going to go over and dive further in depth on this as well. All right, perfect. Thank you.